everyone, it's Cherry Chen from Real Estate Tax Tips again. Today I'm going to share with you the tax impact on refinancing. Yesterday we went through the example of how to pull out equity from your property using the Canadian mortgage system, and today we're going through the tax impact when you take out money from your property. Yesterday, our example is that you originally had $320,000 of mortgage, and upon refinancing 5 years later, you're now qualified to have $480,000 of mortgage. So here's a new mortgage. And now the cash that you can free up from refinancing is about $160,000. So what is the tax impact on this $160,000? Now in Canada, when you do, if you own the property in your personal name, there is no necessarily a tax impact on this $160,000. You can use the $160,000 to do whatever you want. There's no capital gain. The capital gain is not triggered until you sell the property, which makes refinancing a really good option when you need some money. Now, the second part of it is that there is some, because now you are going to take on a bigger mortgage. Now, this $480,000 is a way bigger mortgage than $320,000. Now, that interest expense on this additional money, the additional 160, you're going to pay for it. Now, the only tax impact that you would have is the interest expense on this additional $160,000. If you use this $160,000 for investment purpose and you can show a link to for investment, then you would be able to deduct the interest expense on your tax return. If, on the other hand, you use this $160,000 and buy a cottage for personal use or buy a boat for personal use, there is no business reason behind it. You would not be able to deduct the interest on this $160,000. So at the end of the year, when you do your tax return, you're supposed to prorate the interest related to this $160,000 and the interest that's related to the original $320,000. And you have to prorate it because the interest related to the $320,000 is still tax deductible, assuming this is a rental property. And this $160,000, it would not be tax deductible when you use the $160,000 to purchase a personal use item, a toy, Ferrari, whatever it is. I hope that you would be able to understand my handwriting here and you can see it clearly. Until next time, happy Canadian real estate investing.